Markets that experienced the most notable increase in overall vacancy rates over the past year also saw significant jumps in their 4 and 5 star vacancy rates. However, not all markets saw an increase in vacancies over the past year. Chicago, northern New Jersey, and San Francisco all bucked the trend with demand supply surpassing supply additions. All three markets finished first quarter of 23 at the same levels as a year ago. Sunbelt markets are no longer dominating the rent leaders, as some of the former fastest growing markets have experienced significant rent declines. At the end of the first quarter, the top four rent growth leaders are Indianapolis, Cincinnati, Columbus, St. Louis. In contrast, Phoenix and Las Vegas anchored the bottom of the pack, with year-over-year rents at both at negative 1.9%. To better understand how far the Sunbelt locations have fallen from their lofty highs, all major markets saw falling rents over the past 5 quarters, but the 15 major markets in the Sunbelt saw double-digit declines. CoStar projects the national year-over-year rent growth will moderate further over the next 12 months from 3.7 to 1.8%. Full year 2023 rent growth forecasts for the largest markets nationally show that 75% will not match their pre-pandemic 5-year average, and 7 markets will see rent losses by December. The majority of markets are poised for the strongest rent growth for this year are in the Midwest. Fast forward to 2023, and the tailwinds have become headwinds for investors and owners. 3 things no longer working in favor of investors: a rise in interest rates, a historical record of supply in the pipeline, and rent growth deceleration, according to CoStar Analytics. Business plans that seemed solid a few years ago are no longer as promising. To add to the owner's dilemma, an unprecedented wave of loan maturities is coming over the next 3 years. Maturities will peak in 2024 with a record high of $254 billion. Rates are now hovering around 7.5%, which, depending on the loan to value, is on average about 300 basis points higher than most borrowers' current interest rates. Many owners who have enjoyed cheap capital and excellent terms will have to decide to refinance at higher rates, put in more equity, sell their properties, or give their properties back to the bank. Now, why is this happening? There's definitely a disconnect in pricing between buyers and sellers caused by interest rate increases, less debt available for financing, and a decrease in rental rates. As a result, buyers perceive that properties are worth 56% of what sellers want. And from a seller's perspective, they're slow to adapt to the current changes in the market, resulting in a wide bid-ask spread for multifamily. The bid-ask spread is the difference between the highest price a buyer is willing to pay versus the lowest price a seller is willing to accept. Now, in conclusion, there is a lot of interest in multifamily, although the difference between what buyers want to pay and what the sellers seek continues to widen. Once buyers and sellers adjust their views, they will resolve this standoff. Buyers have already priced in the interest rate hikes and flat rental growth into their valuations, while the sellers are still holding out hope for higher valuations. This trend will continue until maturities pick up and the market fundamentals soften, motivating sellers to meet the market. We have real-time pricing data and understanding of what properties are willing to sell for and can help sellers make the most informed decision on investment opportunities. We recommend that sellers who have purchased assets and enjoyed appreciation on their properties consider taking money off the table and repositioning these assets. While there is an increase in supply and loans maturing, buyers should look at investment opportunities on 10X. For brokers, now is a great time to reset with your clients on pricing expectations for multifamily. Now, if you're in need of an experienced commercial real estate broker, I can be reached at 281-222-0433. I appreciate your time and hope you have a good day.